I'm Jack Chellman, and welcome to the Impact Report, a program from NextGen Planners and the Global Returns Project. We focus on the intersection of financial planning and our planet. We cover sustainable investing, ESG, and beyond, and we have a particular interest in philanthropy. That's because charitable giving really matters for our planet, and because the research says it really matters to clients too. So, welcome to episode 2. Today we're going to focus on the strengths and limitations of sustainable investing. We know that regulation and client demand are making ESG strategies increasingly important for financial planners. But what can sustainable investing actually deliver for our planet? And where does it sometimes fall short? Well, let's dig into that with our first 2 guests in this episode. I'm delighted to say first guest is Mike Jennings, whose career of over 30 years has been spent in investment management as a global equity manager and chief investment officer. He's currently a senior investment consultant to TT International, and we're delighted to have him on the show. Welcome, Mike.
Thank you. Delighted to be here. Thanks, Jack.
Thanks, Mike. Our second guest is Harry Thomas. Harry is co-portfolio manager of TT International's environmental solutions strategy and a senior emerging markets analyst. Prior to joining TT in 2012, Harry worked at UBS in emerging EMEA equity sales. Welcome, Harry.
Hi, Jack. Good to see you.
Thanks to you both for being here. So maybe we could just get into it, and maybe you both could just introduce yourselves again and explain how sustainable investing has factored into your careers.
Sure. Maybe I'll lead off then. As Jack said in the intro, I've been at TT 12 years as a buy-side investor, investing in public stock markets. And throughout that period, sustainability or ESG has been a big part of what I've been doing. It's always been one of the sort of fundamental building blocks of the bottom-up analysis that we've done. But for me as an investor, it really changed several years ago when in 2020 we launched the Environmental Solutions Fund, which I'm the co-manager of, and we have an explicit strategy focused around environmental investing, and that itself has been catalyzed by an emergent interest in environmental issues that I've been experiencing, and a realization that really just wasn't a large number of good ways of investing in the stock market around environmental challenges that we are facing, and that was ultimately the genesis of the Environmental Solutions Fund. So that's me and my backstory of how I ended up in the environmental investing space.
And I'm Mike Jennings. I've approximately 35 years experience in the investment management industry, starting off most of my career as a global equity fund manager, also a period as chief investment officer, and at TT I work as investment specialist. I've been there slightly less time than Harry, 10 years at TT. I'm also a trustee of the Global Returns Project, and really this brings together sort of 2 of my passions really for investment and for environmental issues or the mitigation of environmental problems. And that clearly is the crux of what we're trying to do at the Global Returns Project.
Well, great. Mike, I guess next question to you. This is maybe a simple question, but what does sustainable investing really mean? We hear about it so often, but I know it really touches on so many different topics. How would you summarize it quickly for us?
I mean, it's a simple question, but it's a great question because the answer is the terminology varies. And what I would suggest on looking at this, if you're looking at investing in a sustainable fund, make sure you understand what the investment manager is doing, so you're happy with the solution that you're buying into. So the term sustainable investing tends to be a sort of catch-all umbrella phrase. And within that, there are multiple different flavors, if you like. So many managers use exclusions, which is fairly self-explanatory. often excluding fossil fuel companies, defense companies, for example. There's ESG integration, which is really integrating issues of environmental, social, and governance topics within the process. But again, there are different flavors of that. So you might have a best-in-class approach where you might buy fossil fuel companies, but you might buy the least bad ones, maybe the least polluting ones. Or you might buy any company. And if you have particularly poor ESG scoring, you might need to consider extra risks and you might want to sort of commensurate greater magnitude of return. So there are thematic funds, so single theme funds, such as Water Fund, for example, or multi-thematic environmental funds. And then I guess finally, the other common one is impact funds, where the fund manager must clearly and demonstrably show that the process is creating a positive environmental impact. I'll leave Harry to explain how the TT Environmental Solutions Fund fits into that maybe later on.
Building on what Mike's just said, great overview of sustainable investing. What positive environmental outcomes can sustainable strategies really deliver? And I wonder if there are any examples that come to mind for you.
Yeah, no, I think it's a crucial question, and one that deserves quite a lot of reflection, to be honest. I guess when we're thinking about delivering outcomes, as you phrased it, we're thinking about consequences. We're thinking about cause and effect and things which have changed because of the investment that you've chosen to make. And I think that many strategies often run the risk of claiming credit for things which maybe didn't happen because of their investment dollars. I think it's particularly challenging in public markets. So I think if you're a private debt investor and you finance a renewable development, well, you can say that our debt financing has helped make this happen. If you're a venture capitalist and you finance a startup technology in the green space, then your dollar has had real impact. If you're trading shares on a stock market, then I think it's harder to claim that your ownership has real impact. Now, I still think there are lots of ways which sustainable funds can have impact. They can provide primary capital. So a good example of this, just last week, the biggest holding in our portfolio, which is called Cadila, which is an installer of wind turbines, raised primary money. So they came to the market and said, can we have more cash? We've got a new investment proposal, which was a new offshore wind turbine installation vessel. That's impact, I think. That's an outcome that your sustainable strategy can have. You can definitely have engagement, the way you shape a management team's behavior, you shape their policies, their governance structures to better take into account environmental issues. And that's something we aim for, we track, we measure our performance. And we've got lots of examples of companies we've engaged in, and we think that they've changed their behavior because of our interactions. And most importantly, but most difficult of all to pin down is the role that capital markets play in allocating capital. That's the reason the stock market exists. It's not to give people a lottery game to play. It's to effectively allocate capital towards the most promising companies and to therefore see those companies have their cost of capital, their ability to raise funds, priced appropriately. And we think that happens best when you have dedicated investors who are focused exclusively around environmental technologies, who are appropriately pricing that capital and allocating to the space. But as Mike says, there's a whole range of types of environmental investing, and you need to be very sure you understand what your manager's doing to ensure that you're going to get the impact in the area and the outcomes that you want.
Well, that's a great overview, Harry. I think that those are such important points for people to keep in mind. Maybe a follow-up to you. We've already mentioned that you work on TT's Environmental Solutions Fund. And I know that fund in particular is structured a little bit different from some other sustainable funds in the space. Maybe you could just speak a little bit more about that particular structure.
Yeah, sure. So I guess we've got quite a few differences or quirks within our strategy, which we think make it stand out relative to the peers. I'll start with probably the most striking and the one which ultimately ties into the Global Returns Project, which is that we're structured to give a third of the management fee that we charge for managing the fund and building the portfolio to charities, and to charities which are addressing biodiversity and climate challenges exclusively, so environmental charities. And we've been doing that since the inception of the fund. We give to 4 charities who have global operations, and we consider best-in-class charities. The Global Returns Project is one of those charitable partners. To date, we've given over $700,000 to charity, and our aim, our dream, is that in time that becomes a much bigger number, and that many other the funds copy us. It's a third of our revenues, not of our profits. It has a big impact on the profitability of the strategy. But ultimately, it's one of the main motivators that it makes me want to work on the strategy. It makes my colleagues want to work on the strategy, and we think it represents a really innovative challenge to the status quo, and an idea of how capitalism and philanthropy can be married together for real significant impact on solving some of these challenges. I would say there are other things we're doing differently in the strategy. We're a pure play environmental solutions fund. So Mike mentioned there are lots of different ways of doing environmental investing. We are only investing in companies that have environmental solutions as the heart of their business. So think renewable energy, clean transport, rail, EVs, think recycling, think alternative proteins, electrification, energy efficiency. These are the sort of bread and butter of our portfolio holdings. And also we're genuinely global. So we allocate a lot of our capital to emerging markets. And that's a recognition that a lot of the best opportunities lie in EM, because so much of the technology comes from China or Korea or Taiwan, that a lot of the best renewable opportunities exist in the global south. They exist in Brazil and Chile, in South Africa and India and countries like this. But also that unless we get decarbonization right in the emerging world, then frankly, whatever measures are taken in Europe and elsewhere are not going to be relevant in keeping the planet to the cooling ambitions, or the lack of heating, I should say, ambitions that we have.
Well, that's brilliant, Harry. And interesting phrasing you use there, sort of marrying capital markets or investing with philanthropy. And that's probably where I want to go for the last question, which I'll go back to Mike for. This idea, Mike, of charitable giving being married with sustainable market mechanisms suggests there's complementary activity there. And I wonder if you could speak a little bit about how you see those two complementing each other.
Sure. And yeah, I think that's absolutely right. So in my opinion, sustainable investment is clearly beneficial in the fight against climate change. So to Harry's point, investing in good companies, lowering their cost of capital, and discouraging or divesting from the dirty companies, raising their cost of capital, clearly is a good thing to do. But to your point, Jack, it's only one part of the jigsaw. Consumers are vital in this fight. Regulation is vital. Government interference or influence is vital in this fight. But even that doesn't complete the picture. So who regulates deforestation? Who protects marine life? Whales are huge sequesters of carbon. Who protects them? Maybe the answer is government, but then in international waters it gets a bit complicated. So I think the answer for these things and the answer for those queries is not the capital markets either. So the answer for those kind of examples are NGOs, non-government organizations, charities. So I think if you care about climate change, then yes, definitely invest sustainably, also act sustainably from a personal perspective, but also complement this by giving to the best environmental charities. And this is the key work that Jack and the team at the Global Returns Project do. So analysing the best portfolio of environmental charities. And by giving to those through the Global Returns Project, 100% of your donation is passed straight on to those ultimate charities. So the Global Returns Project don't take a penny for their work. So this is really the holistic solution to invest sustainably in your financial portfolio, but also to invest in the environment through charitable giving. And the two things are two sides of the same coin. They go hand in hand, in my view.
Thank you so much, Mike. And thanks, Harry, as well. I mean, sustainable investing isn't a simple subject, as we've just said, but I think your comments, hopefully they help me, and I think they'll help our viewers better understand it too. Mike and Harry, we'll say goodbye to you now and introduce our third guest, but thank you again for being here. Now, our third guest is here to help us think about these issues from the perspective of financial planning. Really important, right? Ben Smaje is Managing Director of Kennedy Black Wealth Management. He founded Kennedy Black in 2009 after working a decade in the city as an investment banker in the debt capital markets team. Ben, welcome to the Impact Report.
Hi, Jack. Thank you for having me.
Thanks. Well, thanks very much. I wonder if you could just start by introducing yourself again and your practice, Kennedy Black Wealth Management.
Sure. My name's Ben. I run a small financial planning firm based in London. We work with city-based professionals and people who've sold businesses. That's kind of our typical client bank. They tend to be young by advice standards, so most of our clients are pre-retirement. And I've been doing it nearly 15 years.
Fantastic. And Ben, this is a funny question, but I mean, do your clients care about sustainability? Do they want to have a positive impact?
Short answer to that question is yes. I think if you were to ask any client, are you worried about sustainability? I think everyone is concerned. The question then is actually more of what are the impacts of that and what are the potential costs of that? And I think perhaps there's some preconceived conceptions about what it might mean to be investing sustainably. And I think momentum is building. I think I'm finding the conversation resonates more and more with clients. I think a lot of people assume it's young Gen Z types who are a bit more militant about it, but I think the needle is shifting, and I think everyone is now recognizing that they need to do something more sustainable for every generation.
Absolutely. And within that sort of client interest in these issues, what role, Ben, do sustainable funds play in what you're offering?
So, I mean, to take that back a step in terms of the way we operate with clients, we have a very passive investment methodology. We work with sort of what is often called evidence-based approaches to the world of investing. So we want diversification, we want low costs. And I think, well, as time's gone on, we build diversified portfolios for clients, and we have a sort of series of models that form a bit of a structure in that. But we can deviate if either client circumstances dictate or if their desires and objectives dictate. And the question that comes up as we go through our onboarding is around the ethical investing, sustainable investing approach. And we can build that into the portfolios. And I think the tools at our disposal now are increasing. I think there are more and more funds and fund managers who offer a kind of a standard fund and a sustainable alternative that look and smell the same, but what one has this kind of ethical overlay. So it's becoming easier and easier, I think, to substitute without compromising too much on any other factors. And I think my longer term goal is where we are offering sustainable investing for clients that they don't even notice. There's no particular reason we feel like why it should just be a binary decision of one or the other. So that's ultimately the goal, I think.
Well, thanks, Ben. And that makes a lot of sense. I mean, I know we were just speaking with TT International, who worked a very interesting structure into their environmental solutions fund. You've done something kind of similar with a different approach with your clients relating to climate and biodiversity philanthropy. And I just wonder if you could say a little more about what you're doing there.
Sure. So the kind of foundations of the process actually is very similar to what Mike was explaining about that kind of scale of, or that spectrum of sustainable investing, where you have the exclusions, integration, thematic, and then impact investing. And actually the way I think this works smoothest in practice is actually if you continue that spectrum out and say one step beyond impact investing is philanthropy, which is a form of investing, but by design, you're guaranteed to lose 100% of your capital. But if you're marrying that up with a sensible, diversified, low-cost investment strategy that's kind of based on good academic principles, then having a foot in both camps, I think, really does maximize the overall impact that you can deliver. And that is where, the philanthropy thing and looking around at philanthropy options that cover the environmental challenges that we're presented today. And that is where the Global Returns Project, I think, then comes into its own with its diversified type approach as well. So it really does fit in quite nicely with that narrative.
I mean, Ben, when you're actually speaking with clients, how do you bring up the question around environmental philanthropy? How does it fit in logistically with your sort of regular process with clients?
It forms part of our discovery meeting. There's a series of questions we ask now that try and tease out the sustainability conversation. It really is just a dialogue as to say how much of an issue is this. If it is or it isn't, then we can understand and we can dig a little bit deeper as to why.
That makes a lot of sense. I mean, it's pretty simple, right? That's the interesting thing about it. Sure. And I guess, Ben, thinking about maybe just picking one client in particular who's incorporated this idea of climate philanthropy into their financial planning strategy through Kennedy Black, what did they do and what are they doing on a regular basis? Are they satisfied? I'd just be sort of interested in digging into something like that.
Sure. So this was a very recent discussion, actually. The sustainable investing thing, kind of wanting to do sustainable investing that clients don't notice, is kind of a long-term strategy, and I think it's evolving as time goes on. And I went to a presentation that you gave last year, and then the question of sustainable investing and the challenges of being able to give money that has an environmental benefit came up at a client meeting. A client of mine, hedge fund manager, was just basically almost thinking out loud and saying, I'm really struggling with the idea of wanting to do things that are good for the planet and don't know where to go. And it just seemed such a great coincidence that the Global Returns Project had sort of dropped on my radar relatively recently. So, as you know, we got in touch. I mean, the mechanics of it, I understand you're trying to work with platforms in order to allow investment donations or donations to be made out of investment portfolios. But in this instance, that was possibly a little bit too far down the line. So I think the client just contacted you directly and set up a regular standing order. And hopefully it will build from there. So, the client seems really pleased. I think he did his due diligence and really wanted to understand what you were doing. And I think the fact he was a fund manager and you have this fund manager style approach to the way you select your panel and you identify your opportunities, I think resonated with him. And it means, you can cover off a whole load of bases all in one go. The problem I found, I think, before I'd noticed the Global Returns Project was that there are environmental charities out there, but they're very narrow. And I think the Global Returns Project, it's the breadth of impact that's one of the big redeeming features.
Well, fantastic. And really interesting to think about how this idea of philanthropic giving can be just a normal part of financial planning in exactly the way you've described. So thank you very much, Ben, for being here with us.
Pleasure. Thank you very much.
Thanks again, Ben. Thanks to Mike and Harry for all your really, really interesting contributions to this important discussion. And thank you, of course, to all our viewers for tuning in. This is episode 2, please don't miss our next conversation, episode 3, which is going to focus on what clients actually want to do when it comes to climate change. Are sustainable options good business for financial planners? Are they really something that clients want? We're going to be discussing client interest in avoiding negative impact with UK SIF's James Alexander. And then we're going to talk about interest in positive impact with Leading Edge Wealth Planning's Anthony Bruchet. Finally, before we go, this program is co-hosted by the Global Returns Project, which is a UK charity helping financial advisors offer clients high-impact climate philanthropy, often as a complement to sustainable investing. If you'd like to learn more about how to work with GRP at no cost to you or your clients, please do get in touch. My email is jack@globalreturnsproject.earth. Thank you.